Hello, everybody. My name is Ismael Reyes, and I'd like to welcome you to this month's edition of MI Real Estate's Multifamily Investing Update. In this presentation, I'll discuss potential general economic impacts of the coronavirus and presidential elections and whether they may impact multifamily investing. I will finalize with an assessment of national and regional multifamily investing for the remainder of 2020, going into 2021. With regards to the coronavirus, according to a Business Insider article on 16 February, it could cripple China's economy for longer than many in Wall Street want to believe. The article specifically argues that Wall Street is convincing itself that China, similar to during the 2003 SARS outbreak, will bounce back relatively quickly around the end of the first quarter when it expects that the coronavirus is spread to be contained. However, China's economy is growing much more slowly than it was in 2003. In addition, China's financial sector is in much worse a shape than it was back then. It's loaded with debt, and credit conditions are still deteriorating from bailouts last year, necessary due to the U.S. tariffs. This will all make it much harder to fund struggling businesses and local governments there. In related news, earlier this week, we saw the volatility of the stock market here in the U.S. when Apple shares sank as much as 3.2% after the company announced it would miss its fiscal second quarter revenue expectations due to the coronavirus outbreak. Thus, at least in the short term, we can expect to see other companies that depend on global supply chains have similar problems. Relatedly, this market volatility should cause a downtick in already low mortgage rates as investors fleeing the market move their money into bonds. And remember, as demand for bonds increase, bond prices rise and bond yields fall. Bond yields are very similar or tantamount to interest rates. These lower rates may further spur domestic real estate demand, further driving up real estate prices. One exception in the short term could be further stagnation of the luxury real estate market. China has been the most important source of foreign demand for real estate, says Lawrence Yun, chief economist at the National Association of Realtors. Wealthy Chinese buyers often purchase luxury properties such as high-rise condos in California, New York, and Florida. We will also see a softening of the hospitality space due to less Chinese tourists. So the big question is, will China's market rebound at the end of the first quarter, or will we see a severe correction, which will impact global markets, particularly the supply chains? Nevertheless, diversification in the real estate, residential real estate more specifically, or other hard assets such as gold and silver can help in softening the economic blow to investors of a potential longer-term stock market downturn or correction. And speaking of a potential correction, as you know, the U.S. is in the midst of an 11-year economic expansion that many expect will endure through the end of 2020. However, its end may be spurred on by the uncertainty that comes from presidential elections, as we'll see in the next slide. According to Anirban Basu, chief economist at the Associated Builders and Contractors, heightened political uncertainty could induce many companies and individuals to adopt a wait-and-see attitude instead of going out and doing further investing. Which would further reduce economic activity in the context of an already rapidly softening global economic environment. Some indicators toward the end of last year pointed to a slowing in the construction sector. These include rising corporate and consumer debt, uncertainty about material costs, and a lack of skilled labor and the high cost of recruiting and training workers. The good news, Bazu says, is that the construction sector's strong average backlog of 9.3 months as of late January 2020 seems consistent with the notion that America's economic expansion is not on the verge of ending anytime soon. The bottom line is that most contractors expect demand to remain strong and in many cases expand in 2020 despite signs that the overall economy may be slowing or stalling. The general contractor's number one complaint is that they can't find workers who are willing to do the work that they can afford and that it's only going to get worse, he said, noting that the U.S. has 7.3 million unfilled jobs. You could take every unemployed person in America and put them in jobs, and we would still not have enough people for all of the jobs, according to Basu. This transitions us nicely to my last slide, where I discuss the current multifamily market, both nationally and regionally. According to Marcus and Millichap's 2020 North America Multifamily Investment Forecast, which they just put out towards the end of January here, the demand for apartment housing remains at peak levels as the extended growth cycle spurs household formation that exceeds the elevated pace of construction. Looking forward, the pace of absorption will slacken in 2020, not because of reduced demand, but because of supply limitations. With so little slack left in the rental housing stock, even the addition of 300,000 new units in 2020, which is what is expected, will have little impact on the market, as developers have been effective in aligning new supply with job creation and population growth, keeping most of the markets in the U.S. in balance. Zeroing in on specific MSAs where MI Real Estate is focused on for multifamily acquisitions, if we take a look at an excerpt of Marcus and Millichap's National Multifamily Index, which ranks 46 major markets on a collection of 12-month forward-looking economic indicators and supply and demand variables, we'll see that, and we see here on the slide, that the Southeast, particularly Florida, continues to excel. Of note, robust economic and demographic gains propelled Orlando 5 steps, 5 ranks, if you will, to claim the top spot in this year's index, jumping from number 6 last year. Additionally, Tampa, St. Petersburg surged into the top 5 as vacancy tightened and unit pricing climbed. Surprisingly, steady employment gains and cap rates above the national average propelled Fort Lauderdale up in the 2020 index. And this is not something that I expected. Of course, we know that that Miami cap rates, Miami-Dade cap rates have tightened considerably. But I think what's happened is some of that investor pool has pushed on into Fort Lauderdale, and it's now they've started to do some good things there. So it'd be an interesting market to keep a lookout for to see how that's developing. So in summary, many unknowns await investors in the coming year, but the strength of the employment market and positive demographic drivers that reinforce apartment housing demand will continue to favor multifamily real estate investing. So that does it for this month. Feel free to reach out if you've got any questions, comments, or concerns. And as always, invest where it makes sense.